Okay, so this is going to be the last day of our 3-day journey into this chapter 13. So I'm just trying to get my screen ready here. I'll turn this on. So what I thought we would do is I want to go over the last major topic, which is treasury stock. And then once I've covered treasury stock, I'm going to do a problem that's going to look just like the homework assignment that is the connect substitute. Remember, I've done that before, right? So it gives you guys a little bit of a leg up. So just so you know, like if you have your textbook handy, you turn to page 484. You will see the problem that you have to do that's replacing the connect, and that's problem 13-2A. So what I'm going to do is I'm going to do 13-2B, which should be the exact same thing, just a different set of numbers. Okay? And that should give you a huge advantage in doing that particular assignment. Sound like a plan? And then next week, we just spend, one class on bonds, James bonds. Sorry, I have to say that. It's a problem. But that's all, and that's our last topic. So next week technically is the last of anything new. And then that following week is the last week of classes. So that's when everything should be due. So we won't have a formal class. I'll be here. We need to hand stuff in, last minute questions, that sort of thing. Okay. All right. So let's talk treasury stock, and then we'll go from there. So hopefully you can see the screen okay. And of course, you guys probably got my email today, so you may have hit the panic button a little bit, but that was the objective of the email, was just to kind of remind you that things are due and you want to get this stuff in. I had to put zeros in the grade book, but it takes 1 second to change them out. So it's just to kind of, the schools on our cases to make sure we're putting zeros in, because like I said before, some people in previous semesters, they hand one thing in, and if I didn't put zeros in, it looks like they have an A average. And then they're like, how come I'm failing the class all of a sudden? Because I started putting zeros in the grade book, and that brings the average down. So we can replace them easily as soon as you submit them. I sent you 2 emails today. One to remind you to get stuff in. The second was just a reminder of the dates for the portfolio. So if you have, so I think the last portfolio piece that for me to like officially grade with numbers and things of that nature, I think is due today, if I'm not mistaken. Remember the email that I sent you, but check that out. Make sure I get it sometime this week. It doesn't have to be today. So, but if I get it this week, no penalties or anything like that. Okay. I know there is a last component to that project, which involves, what was it, like a PowerPoint or something like that? Yeah, PowerPoint with a reflection, and that's due our last class. So that should be like the easiest thing you do. You're just kind of copying and pasting from your project and putting the stuff in slides like, hey, the company did pretty well. One of the slides should be an income statement. Another slide should be a statement of owner's equity. Another slide should be a balance sheet. And then a summary slide at the minimum. I don't know if this PowerPoint has a minimum number of slides. I don't know if you guys remember seeing that or not. Let's see if I can find it. I don't see it, but you should have a title slide, just as a basic, your name, my name, class name, that sort of thing, date. Then the body of the PowerPoint. So I'm looking for, have at least your 3 financial statements on 3 separate slides, because you won't be able to squeeze them all on one slide. a summary page. So that's for after the title, and then if you quoted anything or summarized stuff from the internet in your summary, you want to use APA formatting, and your final slide should be a reference slide. So that's what I would go by. So nothing heavy duty. So first slide's title, then I should see at least 3 slides of your 3 financial statements, a summary slide, and then if you ended up quoting out of that, make sure you have a reference slide. So I'm looking at 6 slides altogether, so shouldn't be too much. Okay, so let's get into Treasury Stock so that we can get into that problem that looks just like the one you got to do for me. So when it comes to Treasury Stock, this is when a company buys back its own stock. So when a company buys back its own stock, that's Treasury. Let me make this a little bit bigger. Okay. So there are certain transactions that take place when a company buys back its own stock. So when it buys its stock, it's kind of like putting them like in a holding tank, like kind of like putting their arms around them, like mine, mine, mine. Nobody can touch these stocks, right? Until the company decides to reissue them to the market, and then you have to do some more journal entries associated with that. So when a company buys back its own stock, the journal entry typically looks like this. The company will debit treasury stock and it will credit cash. Now, little reminder, when the company issued stock, if you remember, first entry we learned in this chapter, we debited cash and credited common stock. If it was above par, we debited cash, credited common stock, and then we also credited PIK. So we were trying to get cash, and that's why we issued the stock. Right? So you debited the cash, you credited the stock. Well, now we're buying it back, so it's like reversing it. So instead of debiting common stock, which is really what it is, they're giving it a special name. They're calling it treasury stock. So they're just renaming the common that they're removing off the market and putting it like in a different folder, if we had like a filing cabinet. So we're going to call all the stuff that we bought off the market ourselves, we're going to call that treasury stock. Okay? So when you buy back your treasury, when you buy back your stock and you call it treasury, it is now going to go into our little filing cabinet at the price that it was that day. So in other words, whatever the market price, so whatever IBM is selling for today, when IBM buys its stock back, it's going to use today's market price. Okay, so basically, you would multiply the number of shares by the market price. So that would be the math that I would do. Number of shares, if I bought 3,000 shares off our 3,000 of our own shares to remove it from the market, and that day the stock was selling for $10 a share, it'd be 3,000 shares times that, or $30,000. So I'll repeat that this time with numbers. So MP is short for market price. So that's what the journal entry looks like with the math shown. Do you have to show all that math? You can just show it once and that's good enough. Debit treasury stock, credit cash. Any questions with the first entry? So it's basically reversing the issuance of the stock, but instead of calling it capital stock or common stock, when we buy it back, we give it a new name and it's called treasury stock. So it's kind of like special, it's protected. We don't want anyone to confuse this with the stock that we haven't issued yet, the stock that's still on the market. This is the stuff we bought back. So it's like we have it in like a different folder in our filing cabinet, and we just happen to call it treasury stock. So you will not see PIK in excess of par in this section, right? Because we're not working off the par. We will see a PIK account, and that PIK account will be used when you're comparing to this 10. So I don't know if anybody here has ever played basketball or watched basketball. Like when a person's dribbling the ball and they pick up their dribble, they can like pivot on one foot, all right? So they can go this way, they can go that way, but if they start dribbling again, it's double dribble, that sort of thing. So I came up with my own phrase for this $10, and I call it a pivot value, right? Using the basketball analogy. I've been doing that for 30 years. It's no debit aid or liquor or red, nothing that fancy. But I call it pivot because when the company buys its stock, that $10 reflects what it is today, whatever today's date happens to be. When the company feels like it wants to put the stock back into the market, they're going to compare whatever price that stock is on that day to this 10. So they might put it in over $10 or they might put it in under $10, that pivot. All right, the 10 is the pivot foot. They might reissue it above 10, at 10, below 10. It all depends on what the company wants to do. So let's say, this is July 1st. So for the entirety of this treasury stock, we're always going to compare it to the $10 that we paid for it originally. All right? We may have thought, wow, 5 months ago the stock was at 25, now it's 20, now it's 10. It's like, oh my God, we better remove it before it goes down even further. We better start cutting our losses. Let's hold on to it. So then maybe we wait until the stock price starts going back up again, and then we reissue it to the market and make some money off of the resale of this thing. Okay. So the next transaction, I'm just going to make it up. So let's put this in its own little box. So now let's say the company reissues their treasury stock and let's just do 1,000 shares. So they don't want to get rid of all of their treasury stock yet. The company reissues 1,000 shares of their treasury stock at the current market price of, let's say, $15 a share. So right now, let's say it's August 15th. So they've held this thing for like a month and a half. And right now their stock price is at 15 bucks a share. Remember, they took it off the market when the stock price was 10. Now it's 15. Like, oh, okay, let's put 1,000 shares back into the market. We feel like it's safe to put it back in. But notice that the 15, which is what the stock is selling for on August 15th, is higher than the $10 when they removed it from the market. So there's going to be a PIK account, but we can't say PIK in excess of par because that $10 is not par. It's the pivot value. So we just say paid in capital in excess of, actually we just say paid in capital, you know. I don't know what your book uses. Let me just take a quick peek because different books use different terminology. Take a quick peek here. Usually it's just paid in capital in excess of Treasury. Let's see if I can find it. Yeah, it says paid in capital, comma, Treasury stock. So we don't use par. So here's what the journal entry would look like when we are dealing with this reissuance. So on August 15th, we would debit cash, and we're going to debit cash for the 1,000 shares that we reissued, and we're getting $15 a pop for these. So 1,000 times 15. Did I do the math right in the first entry? Yeah. Okay. So we're getting $15,000 by reissuing this treasury stock because now the market is saying these stocks are worth $15 a piece. Right? I'm going to now remove the treasury stock, or some of it at least, from my books. But here's the kicker. The treasury stock has to come off at the pivot value. So when I first bought those shares, they were at that pivot value of 10. So even though I'm reissuing them at 15, I got to remove them at the cost that I got them at. So 1,000 times 10 obviously is $10,000. So that means I made $5,000 over the pivot. My debits have to equal credits just like any journal entry we ever do. So you would just call this pick from treasury stock. I can't say pick in excess of par because par has nothing to do with this transaction. So that would be the journal entry if we issued the stock above the pivot. So now let's say it's August 30th. Company reissues the remaining 2,000 shares of their treasury stock. I'll just write T stock just to simplify here. So the company reissues the remaining 2,000 shares of the T stock at the current market price of $11 per share. So the stock's coming down again. So the company reissues the remaining 2,000 shares of treasury stock at the current price of 11. So why don't you guys try this entry? It's going to look a lot like the second yellow that's already on the screen. So see if you can figure out what the journal entry should look like. And then I'll throw a curveball at you when that's all done. And this is being recorded, by the way, so in case you need to go back and re-listen to this, you can. So the word should look the same. It's the amounts that are going to be different. So on August 30th, you would debit cash. What would be the math that you guys would do? Times 11. Excellent. And what does that give you? 22. Okay. Hopefully you credited Treasury Stock. And what was the math that you did for Treasury Stock? Beautiful. So because, again, our debit is bigger than our credit, we need $2,000 more to balance out on the credit side. So this is where you'll need your pick. And by the way, if you guys want, you can just write, instead of Treasury Stock, you can just write T-Stock. Save you some writing. So feel free to abbreviate it. So, and same thing with regular Treasury Stock too. The one above, if you want to just write T-Stock instead of writing out Treasury, that's fine. So that would just be pick from T-Stock, and technically you could do the math if you wanted to be 2,000 times $1, right? Because $11 versus $10, that's a $1 difference. 2,000 shares times $1 a share gives you 2,000. So you don't have to show that math, but you could to just double check your work. But that's what the answer would be. Great job. Okay. Questions with those entries? Again, I can't use pick in excess of par like we did with the other stock transaction because I'm not selling above par. I'm selling above the pivot value. I'm selling above that original value that I had to pay when I first took them off the market. So now what happens, I'm going to give you a new August 30th. So this is a we're back to, maybe we still have 2,000 shares, but now I'm going to change this. Instead of 11, I'm going to put something like 8, right, and see what would happen if we sell below the pivot. So let's redo August 30th. Instead of reissuing, at 11, we are now reissuing at $8 a share. So it's as if the previous transaction never happened. So in this situation, what you have to remember is that your pick from T-Stock, in this account right here, okay, so pretend this never happened. Let me black it right out just for a second. So it's as if that never happened. So going back to the previous transaction, my Treasury Stock, my pick from Treasury Stock, currently, think of a T account, currently has a credit balance of $5,000. Right? Is it okay for me to ever debit pick from Treasury Stock? Sure. All right, like we're going to have to here because we sold it for 8 when it originally cost us 10. Right? So I'm going to have to debit that account. The problem is I'm only allowed to debit it up to the $5,000 cushion that I created in this entry. So in other words, if I'm doing the journal entry and I'm like, I'm going to debit it for 6,000, I'm not allowed to. The most I can debit it for is 5. So in other words, my pick from Treasury account, my pick from Treasury Stock can never have a debit balance. I can debit it, but it can't be debit heavy. It can't have the debit side bigger than the credit side. All right? So that might happen here. Right? So let's take a quick peek. Let's do this one together. So on August 30th, I would debit cash, and we're going to debit it for the remaining shares, so 2,000 again. At the $8 a share. $16,000. But remember, these 2,000 shares we acquired at 10. So let me show it to you wrong first. All right. So if I said, oh, okay, let me debit pick from T-Stock, and these 2,000 shares. Now, this may turn out to be right. It's possible it could be right. So it's worth a shot to attempt. But remember, we acquired them at $10 a share. So what's 2,000 times 10? 20,000. Got a problem. Because if you remember this transaction, we credited pick in this first transaction for $5,000. So I have a $5,000 cushion. I'm only allowed to debit pick up to that 5. It's the rule, right? Pick can never have a debit balance. So in this first well, technically the second transaction, but the first transaction where pick was created, it got created with a 5,000 credit balance. The most I can debit it for is 5,000, because then it'll be 0. But I can't debit it for 6. I sure as heck can't debit it for 20, even though I want to. The math says to do it for 20. Not allowed to. Right? So in other words, what's going to happen here is the most I can debit it for is 5. So let's just get rid of that whole 2,000 at 10 for a second. That's the most I'm allowed to debit it for, but I needed a total of 20 altogether. So that means the other 15,000 is going to be charged to retained earnings. So not sure if you ended up reading the chapter like I advised last week or not, but you would have seen an example of this nature. And then just like before, we need to get rid of our treasury stock. So we'll know right now if we did it right. Let's call it T stock just to make it easier. So we'll credit the T stock, and that would be the 2,000 multiplied by what we acquired it at, right? And that would be 20,000. So once we do this, we may say, wait a minute, something's not right. So hang on, and we'll fix it. So we acquired it at, was it 10 originally?
Yes.
Okay. So the treasury stock has to come off the books at what we acquired it at. So that's $20,000. Oops. So right now, these numbers don't make any sense because of the fact that they don't equal. I know for sure, let's get rid of this. Let's get rid of this. I know for sure that this number has to be correct because these 2,000 shares that I put back into the market originally cost me 10. These 2,000 shares, when I just acquired them, cost me 8. Right? So let me make a little T account here for a quick second. And we'll call that pick from Treasury Stock, just so you can get a little visual here. So we originally had 5,000 in that account. That 5,000 is a huge cushion, huge, right? So the most I could debit it for is 5. But in this particular case, I am $2 under. So in reality, these 2,000 shares, I would be multiplying at $2 a share. $2,000 times 2, that's 4. So as it turns out, I didn't need this retained earnings. So if I put this in the debit here, my balance in my PIC account is still a normal credit. Okay, so in theory, I didn't actually need that retained earnings. Okay. If I had picked, let's say, a really low number, like instead of 8, what if I had picked 6? Let me throw that in there. So if I go back and redo this question and say, we didn't sell it for 8, we sold it for $6. So if we sold it for 6, 2,000 times 6, that would have made it 12. So let me get rid of that for a second. Get rid of that. Okay. So we're kind of back to what happens if we end up needing this retained earnings. So if we ended up reissuing this stock, we're cutting our losses. Why you would do this, who knows, you know, but maybe they figure it's going to really tank. Let's just cut our losses. So those 2,000 shares we're putting back on the market at 6. 2,000 times 6 is 12. So right now, my deficit between the debit and the credit is 8. Can't do it. I can't use the 8 because if I use the 8, I'd end up with a debit balance in this account. Not allowed. So the most I can debit this would be for $5,000, bringing my balance down to 0 in that account. And then I would use the retained earnings, so 12 and 5 is 17, and I would make up the remaining 8,000 with my retained earnings. That's how that would work. Okay. In the previous example, that we had here, we issued the stock, reissued at 11, it cost us 10. Originally, we reissued it at 15, cost us 10. Here, we reissued at 11, cost us 10. So we were issuing higher than what it cost us. In this last case, we issued it for 6, but it cost us 10. So if you notice, in every journal entry I've shown you, the cash is what we're reissuing it at. Treasury stock is what it cost us. So we always know, like, the first debit and that last credit. Problem is, because we sold it for so much lower than what we paid for it, we were $8,000 short, so I couldn't use the 8. I'm not allowed to. I can't have a debit balance in this account. So I've got a $5,000 cushion that I created in this transaction, and then I use that up, and I make up the difference. So that's just the rule that's associated with that. So having had this exposure, let's now do a sample problem of the homework you got to turn into. Okay? So if you remember at the beginning of class, I said if you turn to the end of chapter 13, your assignment is problem 13-2A. I'm going to do the B version of that one. I'm going to do 13-2B, and then hopefully you've got something you can just kind of not copy off of, but, you know, use it as a reference. Okay? In the new book, it's page 484 for the problem that you have to do for me. The one we're about to do is on page 486. Say that again? Let's see. So this book right here, let's see. I have the 25th edition. I think you may have the 24th. So it should be, let me bring my book towards you. I think, Johnny, you might be in the same boat. Oh, okay. So problem 13-2. So the one we're about to do, 13-2, that's supposed to. Okay. What page is that on? That 13-2A? Okay, so 492 for you guys that have the old edition. That's where the rated one is going to be. The one we're about to do, 495. So very close to.
So 492.
Yep, 492. All right, that down. I'm just going to add it to this file. So when you open up this Excel, you'll see day one's notes, day two's notes, today's notes, along with this problem. So let's turn to page 486. And if you don't have the book, I'll try to type out the questions or read them out loud as best I can. Right. Of course, I forgot my glasses, so this might be a challenge here. All right, and they're right in my briefcase. So
you want me to read it?
No, it's okay. I think I can make. But if I struggle, help me. But I had them right in my briefcase with my laptop. I'm like, I don't need my laptop tonight. No, my glasses were in there. Okay, so anyways, they give us a stockholders' equity section. So this is problem 13-2B. Remember, you're doing 13-2A for grade. And they give us a stockholders' equity section. So let me and I want you to pay close attention to the stockholders' equity section. I see common stock, and then it says $1 par. And this is typically how a stockholders' equity section looks like. And I see 320,000 shares authorized. And I'll explain what all that means. 200,000? 200,000 shares issued and outstanding. So this is a typical lingo whenever you see a stockholders' equity section. The math that you see there at the end where they've got the 200,000, they do that, they get that number by taking how many shares are actually outstanding in the people's hands, which is 200,000 shares, multiplied by the $1 par. So if you're wondering what the heck is that 320,000 shares that they're authorized with? Well, when a corporation first gets incorporated, whatever state they're in, or whatever state they apply to become a corporation, it's kind of like they had to apply, they had to kind of get the rights to so many shares that they're allowed. So when they got their authorization to become a corporation, they were authorized to issue 320,000 shares. So far, they've issued 200,000 shares. So they still can issue more. They still have 120,000 to go before they max out. Once they max out, they could re-up with the state. Say, hey, we need to get more shares authorized, and then you got to go through all that paperwork again, right? So as of right now, the math involved is you take what is issued and outstanding. There could be a difference between issued and outstanding. It could have said 320,000 shares authorized, 220,000 shares issued, 200,000 shares outstanding. Whatever is outstanding, that's what you multiply by the par. So how could issued be different than outstanding? The company may have purchased some of its treasury stock. So there was at one point 300,000 shares issued, but then they removed 100,000 from, the stock market. So now there's only 200,000 shares that are actually outstanding. But because it says 200,000 shares issued and outstanding, there's no treasury stock as of right now. Okay. They also have a PIK account, PIK in excess of par. Yeah, feel free. Thank you. And according to this, but you'll have to help me with I'm so blind tonight. Okay. 1,400,000. So that's how much they issued the stock above par. And then retained earnings is 2 million. Is that 2,160,000? 2,160,000. Okay, so we'll know right away whether I copied those numbers right. So was the grand total 3,760,000 in the book? Yeah. Okay, sweet. And that's your total stockholders' equity. So I'm going to go back to our first class in this chapter, right? When I was comparing non-corporations to corporations. And I started off by saying capital, back in the non-corporation days, used to wear two hats. It wore the investment hat and it wore the equity, or I should say the earnings hat, right? And then when we got to a corporation accounting, we said, whoever created this, they said, hey, capital, you did way too much work. We credited capital when the owner made an investment. We credited capital when we did closing entries. Let's have different accounts do those jobs. So the investment job was handled through stock, along with its sidekick, PIC. So PIC and common are the investment portion, and retained earnings is the closing entry portion. Right? So this is really just saying owner's equity, and here's our capital, like we had in our old balance sheets. Except now we've split capital into two parts, the stock part and the earnings part. Okay, so total stockholders' equity 3,760,000 going into the problem. All right, so then it goes on to say, so that was at the end of December 31st of last year. Okay, and here come the transactions for this new year. Okay, so think of this as 2010, or how about 2020? No, let's make it 2021. And then we're going to be looking at 2022 transactions. Okay, so the first transaction that they have in 2022 says on January 10th, purchased 40,000 shares of its own stock at $12 a share. That's what we just learned, right? That's Treasury Stock. Okay, so let me write that down. So on January 10th, purchased 40,000 shares of its own stock. And did it say $12 a share? Okay, so that's our pivot value. So I'll record the transactions here and then do the journal entries to the right associated with it. So on January 10th, you're going to debit. Now remember, when we first issued stock, we would have debited cash and credited common stock. We're now taking it off the market, so we're kind of undoing that original entry. And we're now going to debit T-stock. And it's 40,000 shares at $12 a share. So 40,000 multiplied by 12, I get 480,000. And we want to credit cash for the same 480,000. So that's just like the first transaction we did today. Any questions with that transaction? So whenever you purchase your own stock, you debit treasury stock, you credit cash. This 12 is now the pivot value. So when we go to reissue the stock, we're always going to compare it to the 12. So hopefully we'll reissue it for more than 12, and then we won't have to worry about that retained earnings issue that we were talking about. Okay, next transaction, March 2nd. And on March 2nd, it says, directors declared $1.50 per share cash dividend. Payable on March 31st to the March 15th stockholders of record. So this gets into the stuff we did last week when we were talking about cash dividends. So declared $1.50 per share cash dividend. Okay, so if you're looking at this date, March 2nd, and you look at who owns the shares as of right now, you will notice that we originally had 200,000 shares that were originally outstanding, right? But now we're going to give these people that have this stock, right, $1.50. However, are there still 200,000 shares outstanding? No, because we just took 40,000 off the mark. We're not going to pay ourselves a dividend. So when we go to pay this dividend on March 2nd, the journal entry is going to look like this. Either debit the shortcut, retained earnings. You do the shortcut if you want to avoid closing entry number 4. Or if you don't mind doing it the long way, debit dividends declared. And we're going to credit dividends payable. So I'm going to get rid of my little dots here for a second and do the math. So of the 200,000 shares that were originally outstanding, there are now 40,000 removed from the market. So there's only 160,000 shares left. This is super, super important. Everybody see where I got the 160? Yeah. The original 200 less the 40. So 160,000 shares, and I'm going to multiply that by the $1.50. God, it's so hard to see in the dark. Not that I was having no issues earlier either when I was seeing. Okay, so 160,000 shares multiplied by the $1.50. $240,000. So in this entry, I will either accept you debiting retained earnings, or you could debit dividends to credit. Your call. I'm just putting both of the two acceptable debits you can use. Okay, it's now March 31st. Pay the dividends declared on March 2nd. So on the 31st, you are now going to get rid of the bull under that expression that I used last week. So debit the dividends payable and credit cash. Whenever you get rid of the bull, you're going to do the opposite of how you created the bull. You originally created the bull as a credit, and now you're debiting it to close it out or to get rid of it. Any questions with the first three transactions? Okay, it's now November 11th. And on November 11th, it says we sold 24,000 shares of that treasury stock. And help me out, what is the new price of the stock? It's the new one's at 12? My book says 13. Okay, all right, so 12 was the original, and now we see that the price has gone up. We're like, okay, let's reissue some of our shares back into the market. We're going to make some money. So at $13 a share. So when you go to do this journal entry on November 11th, now remember, you're reissuing it, so now you're getting some of your cash back that you originally spent in the first transaction. So you're going to debit cash. And the amount of cash that you're getting is the 24,000 times the 13. So 312. Do you guys get the same number? If you don't, let me know and I'll fix it. We also want to get rid of our T stock. And the T stock has to come off at the pivot value. So 24,000 shares at the original $12 a pop. I get 288. So notice that my debit is bigger than my credit. So I need to make up that difference in the credit. So I made 24 grand on this deal. Makes sense, right? $13 versus $12. That's $1 per share times 24,000. So that checks out. And you're going to call this pick from T stocks. So it looks just like the example we did before we did this problem. So now there are 24,000 more shares back in people's hands. Next transaction is December 1st. And on December 1st, it says, look at this, directors declared a $2.50 per share dividend. Let's change that to 250. And the dates are going to be a little different, January 2nd and December 10th. Okay. So there are originally 200,000 shares in the people's hands. We removed 40 back on January 10th, so there were only 160,000 shares outstanding. But since then, we put back onto the market 24,000 more shares. So there's now 184,000 shares outstanding. Bless you. So I'm just going to copy this and then change the numbers.
Are we skipping the 25th?
Did I skip the 25th?
Yeah.
Hey, I guess I did. So
I mean, it's cool.
no. I don't know because I can't read it. So I totally missed it. Let's go back and fix that. So hang on a second. Cut this out and put it over here. Thank you for letting me know. I totally couldn't see very well. So November 25th, what does November 25th say? Sold, the remaining 16,000 shares, right? So and what are we selling the remaining 16,000 at?
950.
My book actually says 1050, so that's a little difference between our textbooks. Okay, so I'll just go with what I have there, but you just write that into your book. Okay, so thank you for bringing that up. So that means this is going to look a lot like the one we just did. So November 25th. It's actually going to make the dividend a little bit easier because it's for the full 200,000 again. So if we are selling our treasury stock, we are going to debit cash, and it's going to be 16,000 shares at 1050. So that's 168,000. We know we're going to have to debit treasury stock, or excuse me, pick from treasury stock. I'll put retained earnings in here just in case we need it. In real life, you wouldn't do that if you know you didn't need it. You just ignore it. And then we would credit T-stock. And that would be the 16,000 shares. And again, we're going to be using the pivot. Okay, so look at what we have here. We've got a debit of 168. I've got a credit 192. So if we do that subtraction here real quick, 190, oh, let me do it over here. So 192 minus 168, that's $24,000 difference. How much of a cushion did I have? I actually had 24,000, so it works out perfect. So I don't need that retained earnings, so let me just remove it completely, and hopefully 168 plus the 24, it does equal 192. Okay. So now it's December 1st. There's no other ones I missed, is there? Okay. So now on December 1st, we declared a $2.50 per share cash dividend on January 2nd to the people who own the stock on December 10th. So that means all that treasury stock that we put back in circulation is now basically owned by people. Okay, so so the original 40 is now back in the people's hands. So we were down to 160, and now the whole 40 is back. So we're back up to 200,000. So now you're going to debit dividends payable. I'm sorry, you're going to debit dividends declared or retained earnings. And you're going to credit dividends payable. And now it's 200,000 shares at $2.50 a pop. So now we're giving these stockholders $500,000 as opposed to last time where we gave them $240,000. Okay. Oh, sure. Sorry. You got it. So now, looking at this next entry, this is going to help us decide, was it okay to use retained earnings, or should I have just used dividends declared? So when we read this next transaction, so if they hadn't put this transaction in here, retained earnings or dividends declared would be fine. But now that I read December 31st, it says closed the 1,072 credit balance in the income summary account to retain it. Oh, okay. They didn't ask us to close the dividends, so we're cool. So you can still do what we did. But now it's saying close the 1,072,000 credit balance into income summary. So on December 31st, closed income summary, and it had a credit balance of 1,072,000. So by them telling you you have a credit balance, it's telling you they had a net income. Net income has a credit balance in income summary. If you had a net loss, it would have been a debit balance. So on December 31st, first off, we would most likely write income summary, closing entries. They didn't ask you to close revenue. They didn't ask you to close expenses. They're just saying, hey, just do closing entry number 3. So on December 31st, we're going to debit income summary, and you're going to credit retained earnings for that 1,072,000. So let's see if we answered the questions in the requirement. Requirement number 1, prepare journal entries to record each of the transactions. Check. Prepare a statement of retained earnings for the current year ended December 31st. Okay, so let's take a look at that. So I think I'm going to go all the way over here for a quick second and just do a quick little review. Non-corporation versus corporation. So you may remember, hopefully you do because you got to do it in your portfolio, the statement of owner's equity. That is equivalent to the statement of retained earnings. In a non-corporation, it went something like this. The beginning capital, remember the owner's name, I'll just do it the right way. So owner name capital, we'll just put January 1st, 2022. And whatever that might be, we would then add net income. This would give us a subtotal. Then we would subtract out drawing. And this would give us our ending capital. So you'll have to do one of these statements of owner's equity in your portfolio project along with an income statement and a balance sheet when you're all said and done. First number in each column would get a $sign. Final answer would get a $sign. But I don't think it's letting me because it's not reading these as numbers. So what you used to know as the statement of owner's equity is the same thing as the statement of retained earnings in a corporation, except instead of capital, we have retained earnings in the spot. So you have retained earnings. And our beginning retained earnings in this problem $2,160,000. Thank you. We would then add in our net income, and that's coming from closing entry number 3. So we would do this math. We don't have drawing, but we have the equivalent of dividends. So the dividends, every time I debited dividends over here, 240 plus 500,000. supposed to be 1231. So what you used to know as the statement of owner's equity, this is now the statement of retained earnings in a corporation. In terms of the heading, it would be company name, statement of retained earnings, and the long date. Okay, and then the last question they asked us for was a new one of these. Except it would be for the year 2022. Okay, so might be helpful. Yeah, go right ahead.
The one where our book had the thing of the we have the 10 as an actor. Your result was 24,000, which came out to the 6, so it worked out. But in my book with the 950, taking off the 40,000. So what do you do?
So yours would look like this. So you would debit the PIK for the 24, and then the remaining 16 or whatever that difference was, you would charge to retain earnings. So in this new edition, they kind of simplified it, where the old book, they made it more challenging. Does that help? Okay. Okay, so as far as retained earnings goes, we originally had 2,160,000 in retained earnings from here. But then through the process of doing these journal entries, retained earnings was credited for 1,072. But because of the dividends declared, we actually debited retained earnings for 240 and also for 500,000. So the total in retained earnings, this plus this, whoops, that's not what I wanted. So the credit side is 3,200,000, the debit side is 740,000. Ending balance in this account, 2,492,000. So that's going to be the new balance in retained earnings. So we started out with that. We had dividends of 240, dividends of 500, and then net income of 1,072 brought our final balance to that. Looking at, did any of the common stock change? I do not see us issuing any more common stock. Those 200,000 shares, yes, they went down to 160, but then they went back up. So that's going to remain the same. PIK in excess of par. I do not see any PIK in excess of par. Yes, there's PIK from Treasury Stock, but that is not PIK in excess of par. So your new stockholders' equity, the only thing that changed was the retained earnings. So it would be the 4092. Okay, and that's what they wanted you to do in part 3. So those are the 3 questions. So this is part 3. Part 2, you don't have to do a side-by-side comparison. I just did that for teaching purposes. That was part 2 right here. You don't have to use the retained earnings T account, but I think it's good to help you do it. And then obviously this was part 1. So hopefully that gives you a little bit of a help to do the one that I have to grade. It's going to be exactly the same, just the numbers are going to be a little different. Okay? You might run into the thing that Katie mentioned, which is maybe in the one you got to do in the A, maybe you have that retained earnings, but I showed it to you in the part before we went over this assignment. Okay, so in the grade book, I went in. Let me just hit those lights here real quick. So what I did in the grade book, just to make it a little easier for you to follow, is obviously, you know, you have the blended Blackboard problems, homework assignments. And then the ones that are the connect, I've substituted, and in the tracking calendar, I have, oh, it's this problem, it's this, you know, problem 2-13-2A or whatever. I went into the grade book and I actually relabeled those connect problems to match, you know, the ones that are in the tracking calendar. So you now know, oh, that's problem 13 too. This is the other homework assignment out of that chapter. So it should be a little bit clearer now. Okay? So yeah, I was looking at that. I thought I had done that a couple weeks ago, but I guess I did. I did in other classes, so I didn't do it for this one. But it's there now. So if you're not sure, like, hey, which, you know, you don't have your tracking calendar with you, the grade book will tell you that. I even have the page number, but it's the new book page number, not the new book. So as long as you know the assignment number 13-2A, just like that. Okay? Anyway, so that's it for tonight. You know, so this was the last part of this material. I will upload these notes. Next week is our last class for teaching and learning, so to speak. So next week we get into bonds, and then the week after that we don't have an official class. That last week is up to you guys. You know what I mean? I'll be here, but you know, if you got stuff to hand in to me, I'll be here for that. But it won't be like, okay, here's what we're doing. So next week is our last teaching learning class. The following week is just, if you're already completed everything, you don't even have to come back. You know what I mean? But if you still have stuff to do, it would be due that night. Okay? And I'll remind you of that next week as well. All right. So this is what we have left. Out of we lost 2 students in the class, so this is our class. So please send everybody like a warning shot email today, 2 of them actually. So make sure you get me that stuff ASAP so I can change those zeros in the grade book. You know, force me to change them, but they're making me put those zeros in, so you're not like, oh, I've got a passing grade, when in reality, you know, you haven't handed some stuff in. So make sure you get stuff in. All right? Have a great night.
This is, like,
Okay.
okay, that's the chart, it's done, I calculated that total for the cost of this whole.
Okay.
Computing units, is it this?
No, it's just right here. So on November 28th, you have 216, 250 at 20, 121, but I only need one. Good night. I only need one amount. I don't need 5 and then 71.
Okay.
So that's the, so this should be on here. So it should be this times this. So this times that. And the parentheses plus, and the new parentheses, this times that, and the parentheses plus, this times that.
Okay,
Okay, and the other one should be on that way.
gotcha, okay.
So if you keep this color coded.
Yep, I would start.
Yeah,
Yep.
so.
I was actually watching, I had to tell you a video.
Oh, okay.
I was reviewing your video and I'm doing it with the video.
Okay, cool. So notice November 1st, you have 2 balances there. I want just, so maybe it's really 8,200, not 3,200 and 5,000. So you always want one total representing each date, like I just did here.
Okay, okay.
Okay?
Yep. I will email you with questions.
All right. Pull this up?
Yeah.
Sure. Oh, move it over?
Yeah, that one.
I actually, since you're I found somebody in one of our classes who actually gone through it too.
Oh, good.
She's done a combination.
What's your name?
So I'm,
That's
I would say,
That's right. Let me know so that I have an idea of, who you're dealing with.
yeah, she's gonna be charged for grade. They were all not using them.
Okay.
So I met with her last week. Helping out with some stuff.
Good.
Tomorrow.
Perfect.
So I got Laura's side, so
All right.
so you might see one big chunk of stuff.
Give it as soon as you complete it, send it so that I'm not grading, everything all at the last minute.
Yeah.
That's the only thing that's kind of like hard
Yeah.
to do, But other than that, I'm glad you're able to find somebody.
Yeah.
She felt bad. She might,
Yeah, no, I figured I'd be able to find that. I know somebody who isn't an actual accountant, and then I reached out to them, and I was like, maybe, but they're not gonna know the material. So then, it's in career services, or career development. And I knew she was a county manager, and it just didn't click. And I was sitting in class, and I was like,
Yeah.
So I asked her, she's like, yeah, I'd love to help, so.
Fantastic. I'm glad. I'd rather have you deal with somebody in-house like Katie was. She had gone through the
Right,
program
exactly.
herself. Because you try to speak with people that have not taken accounting in 20 years, they're just going to mess you up even more, Okay, good to know. Thank you.
Definitely be a good conference.
Okay. I'll be happy to look at it.